think about this for 1 second. Forex is the largest financial market in the world. Over $7 trillion traded every single day, and 90% of the people participating in it are losing money. Every study, every market, every year. In any other industry, a 10% success rate would collapse the business. But here, it funds it because the losses of the 90% are the profits of the 10%. Same market, same charts, same candles, same price. One difference. The 10% knows the script, the program. The 90% are still trying to write it. Ask yourself, if 90% are losing, where is that money going? And why does the 10% consistently win? Everyone has the access of same data, the same internet, the same charts. The answer is not intelligence, not a better strategy, not luck. It is that the 10% understand something that 90% do not. That every price movement on this chart was already scripted before you opened your platform this morning, and their only job is to read it. Now, when most people hear that, they think conspiracy, they think manipulation, they think the market is rigged against retail traders. And in a sense, they are right. But they are right for the wrong reasons. And that distinction is the difference between the traders who loses for years and one who finally starts reading the market correctly. In this video, I am going to show you what the script actually is, how it is written, and the most importantly, how a retail trader reads it and follows it. Not predicts it, reads it, follows it. Stay with me. This one changes how you see every chart from today forward. First, who writes the script? The forex market trades over $7 trillion every single day. Retail traders, people like you and me, account for approximately 5% of that volume. The other 95% is institutions, banks, hedge funds, asset managers, central banks. Now here is the fundamental truth that changes everything. When an institution needs to buy or sell, and we are talking about orders worth hundreds of millions or billions of dollars, they cannot simply click a button and fill the order at the current price. The order is too large. There is not enough liquidity at one price level. So what do? They engineer the conditions that creates the liquidity they need. They move the price to areas where they know retail orders are clustered, stop losses are sitting just below a swing low, buy orders waiting above and resistance level, breakout traders ready to jump in above yesterday's high. They move price to collect the liquidity, and then once they have filled their positions, they take price in the real direction. This is not a theory. This is not the mechanics of how large orders are executed in every liquid market in the world. The movements that look random to retail traders are completely logical when you understand who is behind them and why. That is the script. Institutional order flow, the movement of price to collect liquidity, fill positions, and deliver the price to the next area of interest. Every chart, every time frame, every market. Now every script has structure, chapters, and price action has 4 chapters that repeat on every time frame, in every market, in every direction. Learn to recognize these 4 chapters and you will never look at a chart the same way again. Chapter 1. Accumulation. Institutions quietly build position over time, often disguised as a ranging, directionless market. Retail traders get bored during accumulation. They call it slow market. What is actually happening is that the largest participants in the world are loading their positions. Chapter 2. The manipulation move. Price makes a false move, usually against the direction of the real intent. A sudden spike downward in what will ultimately be bullish move. This spike triggers retail stop losses, activates pending sell orders, and creates the liquidity that institutions use to finishing building their position. Most retail traders get stopped out here. They feel cheated. They were not cheated, they were harvested. Chapter 3, the distribution move. This is what retail traders call the trend. After institutions have accumulated and taken the liquidity they needed, price moves in the real direction sharply with conviction. This is where most retail traders try to jump in, usually too late, usually at the worst possible entry. Chapter 4, Reaccumulation or Reversal. Price reaches its target. Institutions begin taking profits. Price consolidates again or reverses entirely before the next chapter begins. Four chapters repeating continuously on 1 minute chart, the daily chart, the weekly chart. The time frame changes, the script does not. Now, why do retail traders keep losing even they have studied, when they have strategies, when they have backtested their systems? Because they are misreading the script in three specific ways. Fatal error 1. They trade the manipulation move as if it is real move. Price breaks below the key level, they sell. They see a breakout, they jump in. They are trading the false chapter, the stop hunt, the liquidity grab. Institutions designed that move specifically to attract retail participation in the wrong direction, and retail traders walk straight into it every time. Fatal error 2. They trade against the higher time frame script. A trader sees a bearish setup on the 15-minute chart. It looks perfect, they sell. But on the daily chart, price is in a clear uptrend pulling back to a major support level. The 15-minute bearish move is just chapter 2 of the daily bullish script. That 15-minute sell was never going to work because it was fighting the large story. Fatal error 3. They react to price instead of reading structure. They enter because of candle moved, because a level broke, because price booked fast. Reacting to candles is reading noise. Reading structure is understanding context. A candle breaking a level means nothing without understanding what chapter of script you are currently in. All three errors have same root cause. The retail trader is trying to predict the next word in the script rather than understanding the chapter they are currently in. So how does a retail trader read the script correctly? 4 steps applied in this exact order before every trade. Step 1. Identify the higher time frame chapter. Open the daily chart. Ask, is price in accumulation, manipulation, distribution or redistribution? Where in the larger script does price currently sit? This single question eliminates half of all bad trades before you even look at a lower time frame. Step 2. Identify the liquidity that price is targeting. Every price movement is heading somewhere toward a pool of liquidity. Find the nearest resting liquidity, the swing high, where retail stop losses are clustered, the equal lows, where breakout sellers are waiting, the key level where pending orders sit. That is where price is heading. That is the next line in the script. Step 3. Wait for the manipulation to complete. Do not enter during chapter 2. This is where most traders lose. The stop hunt, the false breakout, the spike. Wait for it to complete. Wait for a structural confirmation that chapter 2 is over and chapter 3 is in beginning. A strong rejection candle at a key level after the liquidity grab is your confirmation, not before. Step 4. Execute in the direction of script. Once you have confirmed the chapter, identified the liquidity target, and seen the manipulation complete, you enter. Not aggressively, precisely. With the stop loss below the sweep level, with the target at the next liquidity pool, and with the discipline to stay in the trade because you understand the story, you are not guessing. This is not prediction. You are not guessing what price will do. You are reading what institutions have already set in motion and positioning yourself in their direction. That is the entire edge. I want to spend a moment on something that goes beyond charts and entries. The moment you accept that price is scripted, that it follows institutional logic, not random chance, something fundamental shifts in how you trade. You stop feeling like the market is against you because it is not against you. It does not know you exist. It is simply executing a mechanical process at a scale that makes your stop loss a useful data point, not a personal attack. You stop trying to be right because following a script is not being right. It is about being aligned. A trader trying to predict the next candle is an actor trying to improvise a Shakespearean play. A trader reading the script is an actor who knows their cue and waits for it. And you stop over trading because once you understand the chapters, you know that there are long periods where you are simply waiting for the chapter to change. Waiting is not missing the market. Waiting is reading the script and recognizing that you are currently in the chapter that has no role for you. Patience is not absence of action. Patience is the discipline of trader who understand the script well enough to know when their cue has not arrived yet. The market is not a puzzle to be solved. It is a story to be read. Every chart is script written by the biggest participants in the world. Your job as a retail trader is not to write the next line. Your job is to understand the chapter you are in, identify where the story is going and take your position in alignment with it. Then execute with discipline and let the script play out. That single shift from prediction to interpretation is the foundation of every profitable price action trader I have ever studied or spoken to. It is the foundation of how I trade and is the foundation of everything taught on this channel. If this changed how you see the market, subscribe. Every video here builds on exactly this frame. Join the free TradeX communities, daily market reads, live setups, and direct access. Links are in the description. Drop a comment before you leave. Have you ever been stopped out by a move that then reversed exactly in your original direction? That was chapter 2. That was the script. Tell me about it below. I want to know.